In our culture, hitting a $1 million net worth feels like crossing the ultimate financial finish line. You've escaped the rat race, you have security, and you've won the game. But reaching $1 billion is a different mathematical universe. To get there, you don't just repeat what you did to make a million. You have to multiply that entire $1 million by 1,000. This logarithmic chart shows the true scale of the gap. 1 million seconds is 11 days. 1 billion seconds is 31 years. When that ratio translates to dollars, standard wealth building advice breaks down. Frugality and saving a salary barely register on a billion-dollar scale. The exact strategies that create a millionaire actively prevent a person from reaching a billion. Millionaires diversify to protect capital, stick to safe budgets, and eventually cash out. Mathematically, there are only 3 proven vehicles capable of crossing this chasm. Each one demands a unique, uncompromising price in time, effort, or risk. Reaching a billion requires abandoning standard financial prudence entirely. You have to trade broad diversification for extreme concentration. The first route is the passive indexer. This strategy relies entirely on broad market compounding. This line graph maps a $1 million principal invested in the S&P 500, compounding steadily at its historical average of 10.2% annually. Assuming you never add another dime, the math is inevitable. But crossing the $1 billion mark takes 71 years. Real estate performs slightly better on average. At a 10.6% historical return, pouring your million into property shaves the timeline down slightly, landing you at $1 billion in 69 years. The behavioral requirement here is total operational inactivity. You do 0 daily work, but you must maintain the strict discipline to never touch, spend, or interrupt the compounding principle. Passive indexing has a near 100% mathematical success rate if left undisturbed, but it is strictly a generational wealth play. The original investor will almost certainly die before reaching the goal. The second route is the 100-to-1 stock picker. This is built for those seeking outsized returns without the burden of running daily business operations. This follows the Thomas Phelps criteria, identifying public companies that have massive growth runways and consistently high returns on invested capital. Finding the company is only the first step. The strategy dictates a strict minimum hold period of 10 to 30 years. Investors have to sit on their hands through decades of holding without trading. The mathematical payoff is a dual-engine phenomenon. Your returns multiply exponentially because the company's underlying earnings rise, and the market valuation expands at the exact same time. To capture the maximum upside, you have to buy these assets when they are heavily mispriced. That means allocating your capital when others are panicked due to extreme market pessimism. This requires brutal psychological pain. You have to watch a market crash cut your net worth in half and still refuse to panic or sell. The typical millionaire feels a powerful urge to sell an asset once it doubles in value to lock in the gains. The billionaire refuses to interrupt long-term compounding, no matter how much cash is sitting on the table. This path significantly compresses the timeline to $1 billion, but the toll is entirely psychological. You endure agonizing volatility and refuse to sell when common sense dictates you should. The third option is the business scaler. It's the fastest route to $1 billion, but requires the absolute highest amount of active labor. There is a critical difference between growing a business and scaling one. Growing means adding expenses to acquire new revenue. Scaling means structurally increasing your revenue per employee. To achieve scale, the operational mechanics have to be flawless. You build documented systems, you delegate heavily, and focus on high-margin products. Generating that revenue means nothing if you give away the company to do it. You have to capture the asymmetric upside of that scale by keeping significant insider ownership, at least 10 to 20% minimum. The ultimate target for the scaler is escaping competition entirely. You transition from a standard business into a functional monopoly with absolute pricing power. The trade-off is extreme risk. You avoid diversification entirely. You place all of your capital, your focus, and your working hours into one specific basket. The founder path trades passive patience for relentless operational execution. It is the only realistic way to become a billionaire during your own working years. Choosing your path to $1 billion requires a brutally honest assessment of your personal timeline and your appetite for pain. The first flowchart filter is time. Do you need $1 billion in your lifetime? If no, deploy capital into index funds, letting 70 years of compounding work. If yes, you hit the second filter. Will you run daily business operations? If no, you're a stock picker, stomaching market crashes. If yes, you become a business scaler. Whether you wait 70 years, hold public equities through market collapses, or build a monopoly from scratch, there is one core truth spanning all three paths. Extreme concentration is mandatory. Crossing the chasm from 1 million to 1 billion means permanently abandoning the secure, comfortable mindset of cashing out.